Good evening, students. We will be looking at the foreign exchange risk. It's in study pack chapter 16. You would be having some idea about the risk, the common terminology. Most of the time we use in our normal day-to-day activities. What is risk? It could be having different definitions from the books, but what actually is your actual is different to expectations. If your expectations and the actuals are going to be different, then there is a risk involved. There is a risk involved in whatever we think of activities. There is a risk involved if you see there is a difference between actual and expectation. So it could be a normal day-to-day your business activities or even your personal activities where you plan to do something, and if you are saying that okay, today the train can come at 5 o'clock, that's your expectation, but the train may get late. That means there is a risk involved in the timing of the train arrival. Starting from there, it can be coming to your exams, right? So in your exams, I am sure like all of you all, when you do your exam, then you have expectation that you will pass. But there can be students who fail that exams. So the expectation can be that you want to pass or you are expecting to pass, and then it's still actual being different to your expectation. So then there is a risk involved in that exam, obviously. It's not a sure shot where you say grade 4 student who does the exam and his expectation is passing and then definitely he passes. There is no question about he is not passing. So there is a risk, there is no risk involved in that exam. But there are certain exams you have to accept there are risk, right, in that exam itself. Similarly, if you are going to the overall risk framework, it's in the study pack, it talks about it. I appreciate everyone if you can go through the risk chapter and get the idea about the risk, because that's very important and upcoming area where the most of the organizations have now realized that you need to have a separate function of risk and risk management, actually risk compliance or risk management, and you would have seen that at least larger companies and the banks already have started having a position called Chief Risk Officer. So the role basically to manage the organization risk, touching various aspects, various functions, various departments. Maybe in those days the finance function or some specified function would be looking after risk of the company, and people do not bother to look at each and every division separately sitting and looking at the risk. It is part of your function management, you look after risk. But now organizers realize no, it's basically we have to concentrate on risk of the organization or the function separately, and we need to manage that separately. So that's the common platform I would like to tell, and you need to go through the study pack and understand the overall risk area. It could be starting from strategic risk, reputational risk, legal risk, investment risk, finance risk, liquidity risk, various risk types are there. All those types your organization needs to first identify in detail and plan for those risks to be managed. So we coming to our specific area today is the managing of foreign currency risk. So what is the foreign currency risk? Foreign currency or foreign exchange risk is where your actual exchange rate in the future is different to your expectation. So all of us know today the $1, $1 equal to rupees 183, for example. So if you say 183 is your $1 rate, this can be changing in the future. So future means when I say 1 month's time or 3 months' time, the exchange rate between dollar and rupees is going to be different. That is sure. There is no doubt about it. Definitely it will be different to what you are having today. But there is a situation where each and every company wants to know exactly the rate going to be. But then from the banking circle or the market situation, you would be able to say, okay, the exchange rate will be, say in 3 months' time, $1 could be equal to 185. So 3 months time you are expecting the dollar to be 185. This is your expectation. But actual rate in 3 months time could be different to 185. Why? That is based on that market condition at that day. Your exchange rate can be 185, not 185, it can be 187 or 183. But today you are expecting it to be 185. So what we are going to talk here, the exchange rates, adverse changes in exchange rate resulting in losses. So exchange rate risk is about adverse changes in exchange rate resulting in losses. So we all know that adverse changes only will result in losses. If it is positive changes, there is no losses you will have. So we are concerned about the adverse changes in the exchange rate. For example, say $1 is 185 today. Not today, today $1 is 183. This is today's rate. Today rate is $1 183. 3 months down the road, your $1 can become 185. $1 can become 185. So if it's going to be 185, actually speaking, who is going to gain, who is going to lose? If you are an exporter, you receive dollars from other countries. So as a Sri Lankan company, you will be receiving dollars. So when you are going to receive dollars and you are saying today 183, 3 months time it's going to be 185. So as an exporter, you will gain. When Sri Lanka rupee is going to depreciate, you will gain because you have dollars in 3 months time, which when you go to convert, you convert at not 183, 185. That means for each dollar you get 2 rupee extra in Sri Lanka. So as an exporter you are gaining. But on the other hand, importers, all Sri Lankan company who are importing, who will have to pay more than 183. So what if they imported today at 183, but the payment has to go in 3 months time, you have to pay at 185, the exchange rate is 185. So as an importer, the exchange rate adverse changes will result in losses for importer. So if the Sri Lanka rupee is depreciating in 3 months time, 183 become 185, you are losing. So this is the exchange rate risk. The adverse changes in exchange rate resulting in losses. So 3 months time or 1 month time, any longer or a future period, the exchange rate can change adversely. When they change adversely, you lose as an importer. So we have to be knowing this, the exchange rate changes definitely is going to happen. Only the adverse changes is concern to us, that's the risk to us. On the other hand, I said the definition could be your actual is different to expectation. So exchange rate definitely going to be different to your expectation. So you have exchange rate risk in the future. That's the kind of a initial starting down knowledge you need to have about the exchange rate risk. When we quickly go through some of the terminologies in exchange rate risk. One, what is exchange rate? What is exchange rate? Exchange rate is value of one currency given in another currency. Value of one currency given in another currency. For example, $1 US. So $1 is one currency value. So we are going to give $1 value in rupee term. So we say 183 rupees. So $1 value is given in another currency, say 183 rupees. So this is exchange rate. In other words, if you look at say products, any product you talk, say potato. Potato 1 kg say 200 rupees. So we know the 1 kg potato is 200 rupees. Similarly, $1 value is 200 or 183 rupees. So it's like a price of dollar is 183. Price of dollar is 183. So the exchange rate can be defined as it's a value of a currency given in another currency, or it's a price of one currency. Price of one currency, 1 unit of currency given in other currency. So this is exchange rate. So when you have exchange rate, you have two rates, generally spot rate, forward rate. Spot rate, forward rate. Spot rate means the rate at which your transaction can be done immediately. Immediately. If you are going to do the transaction, you want to buy dollars, $100,000, you can pay X amount of rupees to buy the dollars, and you can buy the dollars today. If you are going to do the transaction today and you are going to pay so much, that's the spot rate. So if I say today $1 is 183 rupees, this 183 rupees per dollar is the spot rate. Why? At this rate you can buy $100,000 or any amount of dollars today in the market or bank. Forward rate is the transaction will be done at this exchange rate in the future. It's not today's rate, it's a future rate. So forward rate is the rate at which you will be doing the transaction in future. So forward rate is that, spot rate is the rate at which you are doing transaction immediately, now, today. So these are two different rates you might see in the organization when you are dealing in foreign currency. Then we have direct quote and indirect quote. Direct quote and indirect quote, the differentiation. Direct quote is where how many domestic currency you need to pay to buy 1 unit of foreign currency. How many domestic currency you have to pay to buy 1 unit of foreign currency. In Sri Lanka we use direct quote system. So if you take normally the bank's quotations, you would see always 1 unit of foreign currency is given equal to how many rupees. In other words, how many rupees you have to pay to buy 1 unit of foreign currency. This is a direct quote system. So Sri Lanka we follow direct quote system. So to buy $1, it's a foreign currency, how much rupees you have to pay. So it's how many rupees or how much of domestic currency you need to pay to buy 1 unit of foreign currency. Indirect quote system is 1 unit of local currency equal to 1 unit of local currency equals to how many foreign currency. In UK, indirect quote system is followed. In UK, they say 1 unit of local currency, that is sterling pound, of their currency, 1 unit of sterling pound equals to foreign currency. I have taken rupees, it can be dollar, it can be any currency. How many units of foreign currency you have to pay to buy 1 unit of local currency? If you are giving, in any country you go, where if they are giving in 1 unit of their local currency equal to foreign currency, it's an indirect quotation. If it is $1, that is foreign currency 1 unit equal to how many local currency, then it's a direct quote system. In Sri Lanka we follow direct quote system. In UK they follow indirect quote system. So you need to be knowing this, because in the examples or questions when you go to do, you may have to look at what quote system has been used. Okay, there are countries which you may not be familiar with normally in reading papers or anything. So you may get confusions, but try much as possible to understand whether it's a direct quote or indirect quote. Even if you don't understand direct indirect quote, still you may be able to go on the logic, I will explain you now, right, to find out the transactions. Now say, if I say $1 is 183 rupees, $1 is 183 rupees. This is today's exchange rate. And 3 months time, you have to supply, you have to settle your imported goods as a Sri Lankan company, and you have to settle in 3 months time the supplier $100,000. $100,000. So how much you will be paying? So you will have to pay 18.3 million rupees in 3 months time at the rate of 183, if the rate is going to be same rate in 3 months time. But if you say, if the rate is 183, you will pay this. Say rupees 185, your 3 months rate, the actual rate is 185, then you pay 18.5 million. So you need to know that this is basically the settlement of transactions in 3 months time based on the exchange rate. Assume you have been given 3 months time, your exchange rate $1 equals to 185 to 187. So, there is a spread given. Spread means you have two rates given, there is a gap between. So, this is called spread. Now, why there are two rates? Why there are two rates? One is called buying rate, other one is called selling rate. So, whenever you are given a spread, that is two rates for the same currency for a period or day, you will have to find out there is something called buying rate and selling rate. Always remember this buying rate and selling rate is from the bank's point of view, not from the customer point of view. If you are a company who is importing or exporting goods and you go and transact with bank to buy dollars or sell dollars, in that process, actually speaking, one person buys, other person sells. If the bank is buying, you are selling, customer. And customer is buying, bank is selling, it's opposite. But this buying and selling rate terminology is always bank's buying rate, bank selling rate. So, the quotation what is given is based on bank's buying rate, bank selling rate, not the customer buying and customer selling. Another question very clearly say that customer can buy the dollars at this rate, then you know customer's buying rate. Otherwise, it's a bank's buying, bank selling. So, if you take 185, 187, Sri Lanka, we are talking about simple example. Sri Lankan company is importing goods, they have to pay in 3 months time. 3 months time, the exchange rate is 185 to 187. Now, what is the buying rate? What is the selling rate? Banks buying, banks selling. If you are a company in Sri Lanka who had imported goods and you have to pay $100,000, you have to pay $100,000. In 3 months time, you have to pay $100,000 to supplier. What do? You go to the bank, and you say that I want to buy $100,000 or I want to have $100,000. Why? I have to pay my supplier $100,000. In order to pay my supplier, I need $100,000. So, the bank will say, okay, fine, you can buy the dollars from us, we sell dollars to you, as a bank I am selling dollars to you, and you have to pay, So, how much you are going to pay? As a customer, you need to pay the bank rupee to buy the $100,000. So, you have got two rates, 185, 187. Now, please note, this is the bank's buying rate, this is the bank's selling rate. These both are banks buying, bank selling. Now, that means, now here we are going to buy dollars, 100,000. As a customer, we are going to buy $100,000. When I am going to buy $100,000, I have to pay rupees to buy the dollars. So, bank has told me the rate. Bank has given two rates. One is a buying rate, one is a selling rate. Bank selling, banks buying. So, bank will say, I am going to sell you $100,000 and my rate is 187. My rate is 187. So, as a customer, you pay 187 rupees per dollar and buy $100,000. So, this is the normal transaction with the bank where you are given two rates, one is buying rate, one is selling rate. In direct quote system, always remember the lower rate is the buying rate, bank's buying rate, higher rate is the selling rate. So, direct quote system, you can memorize that. On the other hand, if you are given an indirect quote system where you might be given say 1 sterling pound equals to so many dollars, you can be given, and there is the two rates, buying rate and selling rate. If it is indirect quote system, the lower rate what you get is the selling rate and higher rate is the buying rate. Direct quote system in Sri Lanka, you can easily remember, Sri Lanka we follow direct quote system, there the lower rate is buying rate, higher rate is selling rate. Indirect quote system, it's opposite, the lower rate is selling rate, bank selling rate, higher rate is the bank's buying rate. So, you can memorize these two. In case you don't understand whether it's a direct quote or indirect quote, say you are being given a Seychelles currency or maybe say African country currency where they are given you buying at rate and selling rate. You don't know which is the buying rate, which is selling, because the quotation is not sure for you, it's either direct quote or indirect quote, you are confused. In that case, remember as a logic, bank will always try to make money out of the transaction. In other words, you have two rates here, 185, 187. We take the same example. We don't know whether it's buying rate or selling rate. And we don't know whether it's direct quote system or indirect quote system. We are not clear. We are told there are two rates given by the bank for $1 and we have to pay the supplier $100,000. To pay $100,000, we have to buy from the bank. So we don't know what the bank's buying rate, bank selling rate. Take these two rates. If you are buying the dollars at 185, you pay 18.5 million. If you are buying the dollars from the bank 187, 18.7 million. In other words, if you are going to buy $100,000 at 185, your payment price is 18.5 million. If the payment or the per dollar cost is 187, you are going to pay 18.7 million. Now please note, there are two rates representing two values. As a customer, you have to pay always more. If you are having two values, always to the bank you pay more. So 18.7 is your customer's buying. Customer is buying dollars at 18.7 million. In other words, bank selling rate this is the selling rate. This is the buying rate. So always remember, when you don't know or when you are confused with your direct quote, indirect quote, you can take the values, two values, calculate the rupee value or whatever currency it is, and see, as a customer, you need to pay more money. In other words, the bank is anyway going to make money. So you have to pay more money, means you have to pay 18.7, which means as a customer, this is your buying rate. Bank's point of view, this is the selling rate. So please be aware, this is a logical way of calculating the buying and selling rate. Otherwise, you may have sometimes confusion. So the best way is to go on the logic. Always, if you are buying dollars or any currency, you have to pay more to bank. Similarly, if you are going to sell the foreign currency to the bank, you get lower value, obviously. So bank will always pay you, right, rupee. If you are going to give dollars to the bank, you get lower value of rupees. But if you are going to buy dollars from the bank, you have to pay more rupees. That's basic logic. So please note, that's basically to get an idea of buying rate and selling rate. Then the exchange rate risk, when you are talking about exchange rate risk, there are three main types of exchange rate risk. Three types you could call it. Those are transaction risk, translation risk, economic risk. So please note, the exchange rate risk is having three subtypes, or I would say composed of transaction, translation, economic. Just look at this example. Today is 7th of September 2020. A Sri Lankan company or Sri Lankan importer imports $100,000 worth goods from USA. So Sri Lankan importer imports $100,000 worth goods from USA. You are importing. So today is 7th of September, and in 3 months time needs to be paid. Supplier needs to be paid in 3 months time. That is when 7th of September means October, November, December. So 7th of December settlement date. So you have imported goods, 7th of September is your purchase date, settlement date is 7th of December. Today $1 is 183. $1 is 183. 3 months time, you are going to settle your supplier. At that time, your dollar is going to be say 185. 7th of December, when you are going to settle your supplier, same goods you have imported, your payment is happening in 3 months time, 7th of December, $1 is 185. So $1 is 183, $1 is 185 in 3 months time. So you are going to pay your supplier in 3 months time. So what is the transaction risk? Your date of purchase and date of settlement. Between these two dates, your exchange rate is varying. So the possibility of your exchange rate varying adversely from your date of purchase to the settlement date is called transaction risk. If you take the exchange rate risk, most of the transactions have transaction risk. So whatever we talk about exchange rate risk, I would say a larger component is the transaction risk. Generally, day-to-day basis, any company who is involved in foreign currency transactions are faced with this risk, transaction risk. So transaction risk is what? Day you purchase, that day you have exchange rate, and the day you settle, that is 3 months later, that day is exchange rate. So the exchange rate between today, purchase date, and the settlement date, the exchange rate can vary adversely. That possibility is called transaction risk. So that's basically the main risk of the exchange rate. It can be on the export side also. You would have exported goods today and you are expecting the money to be coming in 3 months time, and you have exchange rate today and 3 months time your exchange rate can be different. Not 185, it can be different. So at that time your exchange rate can be varying. If there is adverse variability chance, then you have a risk. From today, the purchase or the sale date or export date and the sale proceeds receiving date, between these two dates, your exchange rate can vary adversely. When it is going to change adversely, then you have a transaction risk. So please understand that this is the common form of exchange rate risk. Your purchase date or sale date to the settlement date or sale proceeds receiving date, the exchange rate varying, that variation, adverse variation is transaction risk. Then same, if you take the same transaction what we talked about, 3 months time you have to settle, you have imported goods, Sri Lankan company imports goods, and your imports goods at $100,000 from USA, 3 months time needs to be paid, 3 months time you have to pay. Say 30th September 2020, you prepare your quarterly financials, quarterly accounts. Since you are going to prepare quarterly financials, you have a liability to your US supplier. 30th September, your liability. How much? $100,000, dollar term. You purchased on 7th of September, your $1 is 183. 30th September, your $1 is say 184. What had happened? Your dollar has been depreciating by 1 rupee between 7th of September to 30th September. So this is where you will have to convert your monetary assets and liability under the accounting standards at the exchange rate of the closing rate. So you convert that, you convert your outstanding at this rate. So when you go to convert, you will have to see there is a loss. This possibility, this loss possibility or adverse changes possibility, because you have to do the translation for financial reporting purposes, that risk is called translation risk. So here there is no settlement, there is no cash involved, receipt or payment is not happening, but only the translation is happening. Because of the translation, you may end up with a loss. So that is called translation risk. Earlier what we looked at, you are going to settle or you are going to get sale proceeds, which is going to be different to your transaction date. That is why it is called transaction risk. Here we are talking about your transaction date rate, exchange rate, and your translation date. Translation is generally happening only quarterly. or year end, you do the conversion of your assets and liability in foreign currency. So when you go to convert, there you may end up with exchange rate losses or adverse changes. That risk is called translation risk. Third one is called economic risk. What is that? Due to the exchange rate changes, if a company is losing its competitiveness, it may be losing or gaining, but we will always consider losing as the problem because that is a risk for us. Otherwise it can happen, you may gain the competitiveness also, but we are concerned about the losing, that is a risk we are talking. So exchange rate changes resulting in you losing your competitiveness in the marketplace. So when you are talking about international market where you are exporter, like say garment industry, garments has to be exported to foreign countries. So when you are going to compete in the marketplace, the exchange rate variation can result your company losing competitiveness. So you need to understand that as a Sri Lankan company, you may import goods, that is raw material or fabric and all you import from foreign country for your garments manufacturing. After you manufacture, you export to foreign country. So one side you will import, one side you are exporting. Both you are doing with a foreign country. So due to that, your exchange rate between your country and your supplier country. For example, you may be importing from UK. So your supplier country UK. Your exchange rate between Sri Lankan rupee and the UK sterling pound, or you are exporting to USA after manufacturing. Your Sri Lankan rupee exchange rate with US dollar can vary. When that variation is going to result in you losing the competitiveness, then it is called economic risk. So please note that this is about in the market, mainly international marketplace, you losing competitiveness due to the exchange rate is called economic risk. Transaction is purely you buy goods and when you are going to pay, there is exchange rate difference, that is a transaction. Translation is you buy goods and you have to account for your quarterly end or year end. At that time exchange rate has variation, then you have an exchange rate, that is translation risk. Economic is competitiveness losing because of exchange rate variation. So these are the key types of exchange rate risk. Out of that, main one is transaction. So please be aware, these are the different types of the risk. Then this terminology, sometimes you need to be very, very clear. Say today your $1 is 183 rupees. 3 months time, your $1 is say 187. So if you take from today to 3 months time, the exchange rate has varied first of all. So how do you interpret or how do you say about it? Sri Lanka rupees, what had happened? To buy $1 today, you have to pay 183 rupees. 3 months time, you have to pay 187 rupees. That means you are paying more rupees to buy $1. So $1 you have to buy, you have to pay more rupees. That means Sri Lanka rupee is depreciating. So then obviously dollar is appreciating. So please understand this is a terminology. When you say you are going to pay more rupees to buy $1, that means Sri Lanka rupee depreciating, dollar is appreciating. That is one way of communicating. Second one, which currency value has gone up? Dollar value has gone up. To buy $1, you have to pay more mean dollar value has gone up. Sri Lanka rupee value has come down. Third, dollar has strengthened. and rupee has got weakened. So please note, dollar has got strengthened and rupee has got weakened. So these are three or many ways you can think of, right? Generally the examiner might give you, or maybe in the question you will see this terminology saying one currency depreciated, one currency appreciated, one currency value has gained and strengthened, different names. So when you say these, you need to be very clear that this is the example to just understand what these terminologies are. Okay. Then we move on to how do you reduce this risk? How do you reduce this risk? How do you reduce this exchange rate risk or risk minimization? Risk minimization techniques or methods. Risk minimization techniques or methods. Please be aware, risk is something where you are going to lose, lose because of adverse changes in your exchange rate. So adverse changes in exchange rate, you have a situation of losing. The adverse changes in exchange rate resulting in you to make losses. So there is a risk. So how do I reduce my risk? So minimization of risk. Minimization is the normally people do. You don't generally eliminate as such. If you are talking about elimination, you should not be importing goods or exporting goods. Why? You cannot eliminate the risk. You cannot eliminate, you need to face it. If I say I am going to invest in various investment opportunities and I think I don't want to take any risk in my investments. So if I don't want to take any investment risk, where do I invest? Government securities. I can put it in treasury bill, treasury bonds, I put money in government securities where there is no risk involved. But if I want to earn money or make more return, then I accept that I have to take risk. So if I want to take risk as well as to make money, then I will move from government securities to other investment alternatives. It can be fixed deposit, debentures, unit trust, properties, anything where I know that there is a risk involved. At the same time I get more returns compared to my risk-free investments. So please note, the risk-free investments is the choice where you don't want to take any risk. Similarly, if I say in foreign currency risk or exchange rate risk, I don't want to take any risk. I don't want to take exchange rate risk. If I don't want it, don't import, don't export. If I go to do the import and export, you have to agree that there is a risk involved. But what we need to do, the elimination is not possible, then the choice for all the importer and exporter is what? Minimization. Minimization of risk. Minimization of exchange rate risk. How do I minimize? So generally there is a terminology you would have seen people using, hedging. The risk minimization, the process is called hedging. You can reduce your exchange rate risk. You can reduce definitely, various means are available, various strategies are available, various methods, various techniques are available. So this is called hedging techniques. So please understand, risk minimization is the best strategy a company could take to reduce the exchange rate risk. So what are techniques available or what are hedging techniques available, we will look at one by one. When we are looking at various techniques or methods in managing or reducing exchange rate risk, the classification of those techniques or methods also can be there. Sometimes the examiner uses the word or asking you to find out internal hedging techniques. Internal hedging techniques versus external hedging techniques. So please note all the techniques and methods what we are going to look at, you can be dividing into internal hedging technique, external hedging techniques. Internal hedging techniques are the ones where your company, where say importer or exporter, you can handle these techniques on your own. You are not going into a third party contractual arrangement. You don't need to go for a third party contractual arrangement to minimize your exchange rate risk. But if you are going for a third party contractual arrangement to minimize your exchange rate, that is called external hedging techniques. So please see in the study pack also you will realize that very clearly, internal hedging and external hedging. That's only a classification point. Okay. So we look at one by one the techniques. One, say invoicing in local currency. Invoicing in local currency. If you are a Sri Lankan company, importing goods today, and 3 months time you know that your exchange rate is going to vary, there is a risk involved. So in order to reduce my risk, I am looking for technique. So one of the technique is invoicing in local currency. I have to invoice my supplier, I want to tell my supplier, please invoice me in rupees, not in dollars. Why? If he invoice me, I am going to import goods, right? The supplier say he is from US, we are importing, we are a Sri Lankan company. So supplier is sending goods to us as a Sri Lankan company. I am going to tell the supplier, I need my goods, but please invoice me in rupees. Assume that supplier is invoicing for 10 million rupees. So your invoice, whatever your supplier invoice is 10 million rupees. So you buy today, 7th of September you buy 10 million goods worth. You have to pay your supplier in 3 months time. How much you have to pay? Same 10 million rupees. You imported 10 million worth goods and you have to pay 3 months time 10 million rupees. Now tell me, are you losing any money? No. Why? Your invoice is 10 million, you imported today, 3 months time you have to pay 10 million, no exchange rate impact, you don't have to think of exchange rate risk because your invoice is in rupees. It's like you buying in Sri Lankan market. You buy the raw material in Sri Lankan market for rupees 10 million. Today you buy it at 10 million, 3 months time you pay a supplier again 10 million. No exchange rate impact whatsoever. Same thing, if you are telling your supplier to invoice in rupees, he invoice in rupees, today's value, 3 months time value, same 10 million. But on the other hand, if he has invoiced you $100,000, for example, today your exchange rate can be 183, 3 months time exchange rate can be 185. The $100,000 rupee worth is different from today's value to 3 months time value. So please understand, this is the difference. This is the difference, your risk. In order to minimize that risk only, you can tell your supplier, please invoice me in rupees. So what is actually happening in this local invoicing story, being a Sri Lankan company, your risk is not there. You are minimized. But the other party, US company, needs to face that risk. Why? Anyway, exchange rate vary. So the exchange rate variation, he gets the impact, not you. So this is the invoicing in local currency technique. Most of the time, the countries which has a stronger currency, is able to tell the other party to do that invoicing in rupees or whatever currency, local currency. But if you are a country who doesn't have a bargaining power or your currency is not stronger, then you cannot tell the other party you have to invoice in your local currency. So if you take USA and Sri Lanka, it's very, very unlikely that Sri Lanka can tell US to invoice in rupee. On the other hand, if you are talking about a country where Sri Lankan company can have more bargaining power, then you can tell, for example, X country, where you can tell that X country, please invoice me in rupees. They will agree. But if you are a bargaining power person. But in US, when you take US you can't tell them to invoice in rupees because they are not going to agree. Because Sri Lanka rupee is not that strong a currency compared to dollars. So they will say, no, we go with the dollars. So that is what you need to understand. Even though this technique is one of the technique available, depends on the country's bargaining power, whether you can apply or not apply can be decided. That's one. Second technique is called leading or leads and lags. Leads mean you pay earlier or in advance. Your due date can be your due date of your supplier payment. For example, I am taking all the import related example. 1st of October you are supposed to pay your due date. Your due date is 1st of October, your due date of supplier payment. Today or tomorrow, say for example, 8th of September, due date your dollar can be say 185. 8th of September, your dollar can be 183. So if you are going to pay your supplier, you can pay today or tomorrow morning, 183 per dollar. Or you wait till 1st of October, that's your due date, normally due date, you can pay at 185. So if you are going to pay on 1st of October, you are losing 2 rupees per dollar. You are going to lose 2 rupees per dollar. So the question is whether am I going to wait for my due date and pay, or can I pay earlier to my supplier? By doing that, I am saving 2 rupees per dollar. If I have $100,000, 100,000 into 2 rupees, 200,000 I am going to save. So is it worth for me to pay early? That is the leads technique. You paying early to your supplier to reduce your exchange rate impact. Exchange rate negative impact to reduce, you pay early. This is called leads. Same thing, lags, it's delay. You have to delay your payment. You can delay your payment, delay the payment to get the advantage from the exchange rate variation. So delaying payment to get the advantage of the exchange rate variation. So this is what you call lead technique and lags technique. Only thing you need to be knowing here, if I am going to pay 8th of September, that's tomorrow, instead of 1st of October I am paying tomorrow. Through that I am gaining 2 rupees per dollar. True, I am gaining. But I need to know, since I am going to pay early, what's going to happen? I need to find the money which otherwise I get only on 1st of October to pay the supplier. From wherever the money I am going to get, 1st of October I get the money. If I am going to pay 8th of September, that's tomorrow, that money if I am going to take it tomorrow, there is a what? Finance cost or opportunity cost. That 8th of September to 1st of October, that is 22 days or 23 days of timing, I need to have finance cost. I have to incur the finance cost because I am getting the money earlier from some source to pay the supplier, for which I have opportunity cost. So please note, this opportunity cost has to be calculated and compared with your exchange rate impact or benefit and see what is better. If your finance cost is lower than your exchange rate benefit, then go ahead with the lead technique. If the finance cost is expensive than your exchange rate benefit, then don't borrow money today, pay your supplier. Wait till the due date and pay your supplier. So this is the lead technique. Similarly, lag technique is delaying the payment. Only in the delay payment, there is another concern you need to be thinking. When you go to delay your supplier, what happens? Suppliers will not be happy. Paying earlier the supplier will be saying, okay, fine, you pay me. But not the delay. When you go to delay the supplier, he will say, you are delaying my payments, so I need to charge you some extra. I'll increase my price, or I will charge interest, or sometimes the supplier will not be liking the transaction, or the relationship gets spoiled. So these are the negatives of delaying the payments. But lead, you are paying early, you are fine with it, but definitely you need to know the finance cost impact compared to exchange rate benefit. So that's your second technique, lead versus lag. The third technique is matching receipts and payments. Matching receipts and payments in foreign currency. Foreign currency, receipts and payment you match. So what you are going to do? Say a company which imports raw material and manufacture and sell goods, exports actually. So you are importing raw material in foreign currency and manufacturing and exporting to another foreign country where it's again foreign currency transaction. So your import is in foreign currency, export is in foreign currency, so you have exchange rate risk in both transactions. So what are you going to do? In order to minimize your exchange rate risk, you will have to match your receipts and the payments. How do we do that? Generally the companies open a bank account, say for example dollar bank account, and you get your receipts and put your receipts in the bank and make the payments from the receipts. This is called matching receipts and payments. So you are matching the receipt with the payments, or payments are matched with the receipts. This is used as a bank account because you are putting the dollar receipts into the dollar account, not rupee account. If you are going to put in a rupee account, what's going to happen? You convert the dollars at the exchange rate prevailing today. If you get dollars today, you convert to today's exchange rate and put it in rupee account. Again, when you go to pay from the dollar account, you make the payment, there is no exchange rate risk. But if you are going to pay the supplier from the rupee account, what are you going to do? Again you buy dollars in the market at the exchange rate. So please note, when you are getting the dollars, when you are going to pay the dollars, both times you need to convert at the exchange rate. So you are exposed to the exchange rate variation of the market. So you will have to buy the dollars, you have to sell the dollars. In both transactions, you are going to the market exchange rate. When it is happening, you will have to gain, mostly you may gain or lose, it can happen anyway. But if you are going to use this technique, you have a dollar account, you put the dollars into the account, pay from that account. So there is no conversion taking place for your dollars. Dollar comes, go to the account, from that you make the payment. So there is no exchange rate conversion. Due to that, you don't lose money because of the exchange rate variation. So this is called matching receipts and payments. It's a very good technique. Most of the time the Sri Lankan importers do this, use this technique. Only thing you need to be understanding, the timing of the receipts, timing of the payments. Because you are not going to get the dollar receipts at the same time where your supplier is to be paid. It's not the same time. Supplier needs to be paid say January month, but your export proceeds comes in March. So you are not matching as such in that manner. Second, the amount involved. You are not going to match 100% your sale proceeds with your payments. It cannot be done. Sale proceeds cannot be matched with your payments 100%. Like your proceeds may be $10,000, your payments can be $7,000. Or it can be lesser receipts more than payments. So it can be anyway. So you need to understand that differences are there. Apart from that, this is a very good technique most of the companies prefer to use because you are not converting your dollar what you receive at the market rate, or neither you are not buying the dollar from the market. So there are two times you are, otherwise you have to find the exchange rate impact. Here there is no impact on that. Only maybe if there is a shortfall of money, dollars you have to pay, that only you have to convert from the market, that exchange rate impact comes. Otherwise there is no impact of exchange rate risk. So the fourth technique is netting. So what is netting technique? you would see that in a multinational company, the company will be having transaction with their counterparties who can be different countries. So you being a company, multinational company, you have your other subsidiaries or maybe your associate or whatever your group companies which have transaction with you and resulting in receivable and payable. You will have receivable and payable with various country companies, your company, your multinational company and your group company in different countries. So your receivable and payables. So what happens? For example, you are receivable from one country or one company, say X company, in another country say USA. With the same company, you might have payable 60,000 or say 60,000. So actually speaking, your receivable is how much? 40,000. So you have a receivable, you have a payable, net amount is 40,000. So if you are going to talk about your receivable and payable with one company in another country within the group, then what you can do, you can set off the receivable and payable and take the net amount and convert and pay. So you are, or convert and receive money. It can be only the net amount will be exposed to the exchange rate risk. You have to convert only the net amount. Otherwise, you have to convert 100,000 separately and 60,000 separately. To avoid that, you can do the netting. This is what it's called netting. It's a more of accounting transaction more than the exchange rate risk management, but it also results in the exchange rate risk reducing. So $40,000 is the net amount you will have to pay or receive, in this case receivable. So you receive that money, only 40,000. So the exchange rate impact will come for 40,000, not for 100, not for 60. So this is the netting transaction. So netting can be two types. One is bilateral, other one is multilateral. Bilateral, multilateral. As you know the word, bi mean two companies. So here we talk about receivable and payable, right? Your company and X company. So two companies are involved. Multilateral, it can be with many companies. If you are being a group company, it can be 7-8 companies in the group. So what you do in like consolidation, where you put your intercompany receivable payable, you put in your chart or table and you have to set off your receivable payable within the group and net amounts only you have to pay. Not with one company, many countries actually, you have to set off your receivable payable and net amount you pay. So the group treasury has to look at it and tell you, advise you, okay, who has to pay, who has to receive. So in that way, you are reducing your foreign currency transaction or outstandings, converting at different exchange rate many times. You avoid that. So by doing that, your exchange rate losses will be reduced or minimized. This is called multilateral netting. If it is two companies like this example, your company and X company, you have receivable payable, net off amount and pay. That is called bilateral netting, only two companies involved. If you have many companies in the group, you set off your receivable payable within the group, net amounts only has to be settled by somebody. That process is called multilateral netting. So this is actually a very good thing, especially where it's a group company transactions. This is very good to reduce the exchange rate impact. Then fifth technique, matching assets and liabilities. Matching assets and liability. So what is this technique? We looked at earlier matching receipts and payment, where you are receiving export proceeds and you have to pay your supplier. So your receivable, receipts and the payments you can set off. So how do you set off? You have a bank account in foreign currency, put your receipts there, pay from that. So you are using that. So your transaction gets sets off there. So you don't exchange rate, you don't convert both transactions. Matching assets and liability. For example, a Sri Lankan company, say, invest in Maldives. Sri Lankan company invest in Maldives. And the Maldives investment, you are making say $10 million. $10 million. So this is the investment you are going in Maldives, say maybe a resort you are buying or investing $10 million. In order to invest $10 million, you can borrow maybe in Sri Lanka or in Maldives in again dollars, say 10 million. You are going to invest in Maldives resort $10 million and you can borrow $10 million in Sri Lanka or Maldives, whatever the country. You borrow the similar currency amount to borrow and invest in that same country. So what I am going to do, I am borrowing in dollars and again investing in dollars. Maybe I am just taking a simple example, 10 million both. May not be you don't borrow 10 million, you may borrow at 8 million. 2 million you have to put it from your local currency and convert. But you are going to borrow some amount to match your investment in the same currency, So if there is exchange rate impact, the exchange rate changes negatively, you are not worried much because you are having an asset and a liability in foreign currency. So even if the dollar appreciates and Sri Lanka rupee depreciate, you will gain on the asset side, lose on the liability side. So it gets sets off, net amount of impact is not there. So you are saved from that exchange rate risk by doing the asset matching. So you need to understand that any foreign currency asset investment, if you can borrow in the same currency and invest, your exchange rate risk is minimized. Practically you may not be able to borrow in the same currency for the same amount, but you would do some portion of your borrowing in the same currency so that your exchange rate risk is lower. Because you are talking about investing in Maldives for what? Because you understand that you have a business there or you can make money in that business. So you are talking about a business proposal where you make money there. That business proposal has business risk. That's only business risk. Where the demand can come down, cost can go up, all that is demand related and business related. You are not concerned about the exchange rate risk there. You are not going to focus on exchange rate risk. So you need to find a way to minimize the exchange rate risk, then you concentrate only on the business. So one of the technique which help you to concentrate on business is matching assets and liability. So please understand, this can be easily understand. Any asset you are investing in foreign currency, please try much as possible to borrow in the same currency. If you can borrow in the same currency, you can invest in the same currency, your exchange rate risk is minimized, or to great extent you are out from the exchange rate risk. The sixth one, forward exchange contract. This is a technique which is mostly you would see in export-import transactions in Sri Lanka. Forward exchange contract. So what is forward exchange contract? This is an agreement between bank. It's an agreement between bank and customer. Bank and the customer. So both of them agree to do what? To buy or sell a quantity of foreign currency. Bank and customer agree to buy or sell a quantity of foreign currency, not today, on a future date. They will agree saying that we will buy, customer will say, I will buy $100,000 in 3 months' time from the bank. Today he is agreeing to buy in 3 months' time on a future date at a rate agreed today. Your rate of exchange is agreed today. You are going to do the transaction in 3 months' time, but the rate at which you are going to do the transaction in 3 months' time, that is agreed today. For example, you say $100,000 are your imported goods, 100,000, 3 months time I am supposed to pay, 3 months time I am supposed to pay $1. I agree today, we will buy the $1 at 184. This is the forward exchange contract rate I have agreed with the bank. At 184, 3 months time I will buy. 184, I will buy the dollars in 3 months time. Please note, this agreement is very important to note, is binding. This agreement is binding. Why do we say it's binding? The customer and the bank both have their rights and obligations. They both have rights and obligations under this contract. What do you mean by rights and obligations under this contract? 3 months time, your dollar rate is actual dollar rate. This is your forward exchange contract rate. Forward exchange contract rate. $1, 184. Your actual rate $1 is rupees 185. Assume that actual exchange rate in 3 months time is $1 is 185. Today you have agreed with the bank that I will buy the dollars at 184 in 3 months time. But 3 months time actual rate is 185. Now please tell me, what is the rate at which as a customer you will buy dollars from the bank? 184 or 185? Actual rate is 185, contracted rate is 184. You have to buy dollars at 184. This is called binding contract. Why it's binding? As a customer, you have to buy at 184. Bank is supposed to sell. Bank is supposed to sell at 184. Bank cannot tell, no, I can't sell it at 184 because market rate is 185. Bank cannot say that. Why? Bank also signed this contract. That's why I said the bank is obliged. There is obligation from the bank point of view to sell the dollars at 184. Customer point of view, he is having the right, he has the right under the contract to buy the dollars at 184 even though market rate is 185. This is the advantage as well as the disadvantage for different parties under the binding contract. So as a customer, you are minimizing your risk. How do we minimize the risk? Because you are ensuring what is your supplier payment going to be. So you don't have a doubt how much going to be there. You know that your 100,000 will be paid at 184. So if your actual rate is 185, you are gaining. Why? You are committed to buy at 184. That means bank is also committed to sell at 184. You are gaining there. But it can be other way also. Why? The actual rate can be 183. If the actual rate is 183, as a customer, you prefer to buy the dollars in the market. 183 is cheaper for you. But bank will say, no, you are obliged to, as a customer, you are obliged to buy dollar at 184. Even though actual rate is 183, you have to buy at 184. So please note, this is a forward exchange contract. It's a binding contract between the buyer and the seller to buy the foreign currency, quantity of foreign currency on a future date at a rate agreed today. So you need to be very clear here. This is a very binding contract where both parties have the rights and obligations to honor the transaction. So the actual rate can vary. Still, both of them have to go by dollar agreed rate 184. This is the binding contract. So sometimes you will see customer benefiting because of the binding contract. Sometimes you will see the bank benefiting from the binding contract. Whatever case may be, it is a binding contract. So nobody has a chance of deviating from the contract. If you are deviating from the contract, you are violating the contract. So under legal provisions, each one can be sued where you are not obliging the contract. Then the seventh technique with option contracts. Option contracts. So what is option contracts? These are contracts you can get from financial intermediaries or banks, which basically gives you right but no obligation, right, but no obligation to buy or sell a quantity of foreign currency on a future date, at agreed rate today. Please note, option contracts are contract which you can buy, which gives you the right but no obligation. Forward exchange contract, right and obligation. It is a binding contract. This is not binding. Option contract is not binding. It gives you right but no obligation to buy or sell a quantity of foreign currency on a future date at agreed rate today. So all other information or the characteristics are like forward exchange contract. Only key difference is this gives you right but no obligation. So please note, the option contract also it's a contract which gives you the right and no obligation. That difference is there. Other than that, to buy or sell a quantity of foreign currency, that is you are going to buy dollars, $100,000 in the future date, at a future date is also there, at agreed rate today. You can decide how much you are going to buy at, today you have agreed. This is option contract. Now look at this. We say today rate $1 equals to 183 rupees. 183 rupees, $1 today. 3 months time, $1 is 185. So this 3 months time 185 is your option contract rate. 3 months time, $1 is 186 actual rate. 3 months time, your $1 is 186, that's your actual rate. But your option contract, you have got the option contract that is at $1 equals to 185 rupees. So your option contract gives you the right to buy the dollars at 185. Your market rate is $1 equal to 186. Now tell me at what rate you are going to do the transaction. $1, your option contract tells you at 185 you can buy, your market rate is 186. Which one you will buy it at? You realize buying in the market $1 is 186, which is expensive, than you utilizing your option contract right where you can buy it 185. So what do? You will exercise your option contract and you buy the dollars at 185. You don't go with the market, you go with your option contract. That is where you see that option contract exercising is beneficial to you. Since you want to buy the dollars, you don't want to buy it at 186, which is actual market rate, you buy it at 185, which is available in the market. Through your option contract you are buying at a 185, which is cheaper than 186. On the other hand, your actual rate is 184. Your actual rate is 184 and option contract 185. So you have option contract in your hand which gives you right to buy dollars at 185. Whereas the market dollar is 184. What are you going to do? Are you going to exercise your option contract or are you going to ignore your option contract? Since the option contracts have only right, no obligation, No one is going to find fault with you if you don't exercise your option contract. You can ignore your option contract. Why? Your market rate is favorable to you than the option contract. So you ignore your option contract. There is no binding on your part. You can ignore your option contract by the dollar as 184, which is advantageous to you. This is what option contract. You have the right, no obligation. You don't have any obligation. So the bank or intermediary or anybody in that manner will not be finding fault with you or file a case against you saying that you didn't exercise your option contract. There is no need. There is no need. That's the beauty of option contract. Forward exchange contract, if you have a situation like that, you have to abide by the contract. But option contract, it's not binding on you. It's only a right, no obligation to buy yourself foreign currency. So always remember, when you compare the forward exchange contract and the option contracts are beneficial. Option contracts are beneficial because even if the market rates goes to favorable situation, you can go with the market and not with the option contract. But in a binding contract and the forward exchange, you have to go by the forward exchange contract rate, not by the market rate. So this is the main difference between option contract and forward exchange contract. And people prefer to have the option contract than the forward exchange contract. Only thing you need to remember, in order to get the option contract, in order to buy the option contract, you need to pay a small cost, which is called nominal cost. Nominal cost. You have to pay a nominal cost to buy the option contract. Small amount, but you have to pay that to buy the option contract. Since it's a small amount and it is not considered for your decision making, this is called sunk cost. This is called sunk cost. Even though you buy the option contract paying a small nominal amount, whether you exercise your option contract or not exercise option contract, this cost what you have paid to buy the option contract is gone forever. So you cannot recover that cost, therefore it's called sunk cost. Your decision making is not relevant to your cost incurred. Just because you have incurred cost, you are not supposed to exercise or you are not obliged to exercise. Your exercising decision is based on your market condition. Therefore, please note that this is not relevant, this is a sunk cost. So please knowledgeably understand option contract is beneficial than forward exchange contract. Forward exchange contract gives you the binding nature, option contract gives you only right, no binding nature. Then the eighth technique, money market hedging. Money market hedging. Money market hedging. So what is money market hedging? You may know that capital markets are long-term financing environment or a market. Money market are short-term instruments trading or available in the market or environment there. So money market hedging is where you use the money market instruments in order to minimize exchange rate risk. Money market instruments are used in order to minimize exchange rate risk. So what are money market instruments? You will talk here. It's about your deposit and borrowing of short term. Deposit and borrowings of short term we use to minimize the exchange rate risk. For example, if you are having a supplier payable in 3 months time in dollars, supplier payable in dollars in 3 months time, you have a liability. 3 months time you have a liability in dollars. So what you need to do to match your liability in 3 months time, the dollar liability, you need to create a dollar asset. So how do you create? You will borrow in rupees, convert into dollars and deposit in dollars. So you will borrow in rupees, convert into rupees, you will borrow in rupees, convert in dollars, and the dollar converted amount will be deposited in dollar account. So your dollar account deposit will be available in 3 months time to pay your supplier. So where you will match your dollar liability with dollar asset, and finally what you are having is a rupee borrowing. So what you have done, you have converted your foreign currency liability to ultimately rupee liability. This is, you are working with deposit and borrowing. You borrow in rupees, convert into dollars and deposit in dollars. So you are converting the foreign currency borrowing or liability to rupee borrowing. This is the money market hedging. So I would like you to go through the tute or the notes, right? You are trying to create an asset for liability in foreign currency. Create an asset. This finally what you need to know is you will have a supplier liability in dollars in 3 months time. What you need to do is you need to create a asset, generally it's a deposit, it's a deposit in 3 months time in dollar term. So the objective finally is to set off your liability in 3 months, you need to have an asset in 3 months. So how do I create this asset? That's why I said you borrow in rupees and convert and deposit in dollars. Borrow in rupees and convert and deposit dollars. So automatically in 3 months time you have this dollar deposit which can be used to settle your supplier. So when you set off your asset and liability, what you are left over is your borrowed money in rupees. So 3 months time you are rupee borrowing. So you are not exchange rate risk you are not going to face exchange rate risk. Why? You have a liability in dollars, you have asset in dollars. So asset in dollars and liability in dollars both sets off. So you are ultimately having only rupee borrowing. This is called money market hedging. So this can be looked at from the other side also. You have a receivable in foreign currency, then you have to have a liability in foreign currency. If you have a receivable, that is your export proceeds are going to receive in 3 months time, say $100,000. For that you should have a borrowing in 3 months time, same dollar term. So those two sets off, for which you are not going to borrow in rupees, you will borrow in other currency and invest. So it's opposite direction. You may go through the tute or the study pack, that examples are given there to understand the transaction. Then there are other two techniques. I am not going to talk about it now. You can look at the study pack, that is futures and foreign currency swaps. So you may look at the study pack, which is very self-explanatory. Futures and foreign currency swaps, those are other two techniques available for foreign currency risk management. So as I mentioned to you, in order to minimize the exchange rate risk, there are various techniques are available. So the list has been gone through here. I think almost 10 techniques are available. Out of 10 techniques, you might see that certain times certain techniques are more relevant, certain times certain techniques are more relevant. And being a local company, Sri Lankan company, some techniques you may apply, some techniques may not be easy because futures or foreign currency swaps may not be available for normal export import in Sri Lanka. In that case, he is mostly involved with the matching receipts and payments or forward exchange contract or my leads or legs technique. If you are a part of group company, then you have a netting technique. So please apply your theoretical knowledge when it comes to exam, whether it's relevant, whether these techniques are relevant. You can't memorize all 10 techniques and say all are relevant for every company. No. For that case, whatever is given in the exam, you have to find out what is more relevant. So please apply like that. Then in terms of foreign currency risk management, I would like to say when you say this exchange rate risk, what are the impact? What are the impact or consequences of this risk? Since adverse changes are going to happen in an exchange rate, what are the impact we are going to have? There are various impact you would see as a company. I am not talking about country, I am talking about company. What are the impact the company will have? If you are talking about your importer, your cost of imports increases, or cost of sales or cost of imports increases because of exchange rate variation. Say example, your dollar rate is 180 and it becomes 190. What happens? All your import goods, cost of import goods will increase. So that's the main impact on your imports. If you are going to export, I am talking about adverse impact, negative impact I am talking. You can think of positive side also, but the risk is about always negative side. Like cost of imports, sales goes up and export proceeds can come down. Export proceeds can come down. If the Sri Lanka rupee is depreciating, you are gaining. If the Sri Lanka rupee is appreciating, 180 become 170, then export proceed comes down. So please note, even $1 you are selling $1 for a water bottle, $1 you are exporting. Suddenly the 183 rupee per dollar become 175. So as a Sri Lankan company we will get $1, but the rupee value of the $1 is 175. So 183 become 175, 8 rupee we are lost. So the export proceeds can come down. Then if you are borrowed in foreign currency, you need to understand in a borrowing, say bank loan or any foreign currency loan, the cost of finance, cost of capital is interest plus foreign currency depreciation or appreciation. Foreign currency loans, your finance cost or cost of capital is interest plus foreign currency depreciation or appreciation, both together. So you need to understand that bank loan or foreign currency loan, this cost is your cost. If your exchange rate, Sri Lanka rupee depreciating, your foreign currency depreciation is more. Then your finance cost, what happens? Bank loan, foreign currency loan, finance cost increases. So please note, the exchange rate risk is you are getting impacted to your foreign currency loans, finance cost increases. Rupee loan, no problem. Your rupee loan normal interest is remain to be normal interest. But if you are talking foreign currency loan, your foreign currency interest is there separately. That will not change. 5% means 5%. But your exchange rate depreciation also will added to your finance cost. So that is total will become your cost of capital or cost of loan for the foreign currency, which will go up when the exchange rate depreciates. Then your cash flows drop. When you say the exports reducing, cost of sale increasing, cash flows drop. Then the assets, your assets value drop. Say for example, you have invested in, say earlier example Maldives, you have invested in the hotel and Sri Lanka rupee has appreciated. You put $1 million in Maldives at 183 rupees. 1 year later, your rupee value is 175. So the assets value drops. It's not just the asset, it's foreign currency assets. So exchange rate movement will impact your assets value. Your liability can increase. You are borrowed in foreign currency. If you are rupee borrowing, 10 million loan. But foreign currency loan, if you have borrowed $1 million, your $1 million rupee value will increase when the exchange rate, your Sri Lanka rupee depreciates. So your liability increases. Then your value of the company can drop. When your value of the company drops, when your cash flows are dropping, when your cost of capital is increasing, all of you all know the cash flows are dropping, cost of capital is increasing, obviously our company value comes down. So the exchange rate risk can impact in many forms, and sometimes you need to know that worst scenario, very, very high risk environment where you are borrowed heavily in foreign currency and your currency you are borrowed as depreciating, your currency depreciating against that other currency seriously, then you may be forced to bankruptcy. That's a worst scenario. It's not a normal situation. Very, very, very rarely it can happen, but it can happen. So please note, these are the impact of foreign currency risk. Why you need to manage the risk? The reasons are these. This is not a smaller thing. It's a very, very significant impact if you are exposed to foreign currency risk. If you are a local buying and selling company, you are manufacturing local goods and you buy raw material locally, you sell locally, no exchange rate impact, then you are safe. But if you are importing raw material from foreign country and manufacturing, exporting to foreign country, then you are exposed to this. Risk can be impacting you in many forms. So you need to know the impact to the organization depends on to what extent you are exposed. People think that exporters are not affected. Exporters also, if they are importing most of their raw material, again they are exposed to exchange rate risk. And 183 at the moment we think, okay, Sri Lanka rupee generally depreciates. But suddenly if the Sri Lanka rupee appreciates, then even the exporters are losing. So you need to know that it's not something you memorize. You need to understand how the foreign currency risk can impact the organization. And we being a country where we have a majority are imports, majority of the goods are imported at this moment, we are exposed to the exchange rate risk severely. And as a country has foreign currency borrowing heavily, and the country is always dependent on imports on, say, oil. We import oil a lot, then import some of the capital expenditure items imported. So then the country as a country, not the companies, country point of view also you are exposed to foreign currency risk severely. Mainly the loans and imports, oil, capital expenditure items. So you are exposed. So these are the things you need to be clearly understanding when the exchange rate varying. From when you read papers where the country foreign currency exchange rate has appreciated or appreciated, please be aware that is impacting companies and the country severely. Depends on what company you are. If you are only doing transaction locally, buying and selling in locally, not a single import related transaction, then you are safe. But otherwise you are exposed to the risk. That is why we said how to minimize this risk. We need to minimize the risk, otherwise you can be facing all these problems. To minimizing initiation techniques, we looked at 10 techniques I think. All 10 techniques may not be relevant all the companies. Some company can use some techniques, depends on the need and depends on the availability. If you take futures, foreign currency swaps in Sri Lanka, we don't have severely or available in the market to buy or sell, so people may not use it. But forward exchange contract, matching receipts and payment, matching assets and liability, leads and legs, all are techniques you can do on your own. So these are available with the market also. Okay. Then there is a slight discussion I would like to make on the parity theories. So example, $1 today is 183 rupees. This is today. Say 1 month's time, $1 could be rupees, we don't know. Today $1 183, 1 month's time $1 can be any amount. It can be 184 or 182 or 175, we don't know. So we need to know how to forecast this rate. How to forecast the rate. How do we do that? So there needs to be a way to forecast the future rate. So there are two theories mainly. One is interest rate parity theory. Other one is called purchasing power parity theory. Actually speaking, today's exchange rate and future exchange rate are different. Why they are different? There could be various reasons. So please note why your today's rate and future rate of exchange is different, various reasons. One could be your interest rate differences. The two countries' interest rate can be different. Sri Lanka and US, if you take, Sri Lanka and US interest rates are different. So when the interest rates are different, you need to understand that today's exchange rate and future exchange rate will be different. That is one. Second reason, inflation differences. Today's exchange rate and the future exchange rate are different. Why? Because inflation is different. Sri Lanka inflation can be 5%, US inflation can be 2%. So because of the inflation differences, your today's exchange rate, future exchange rate is different. Third, risk factors. Two countries' risk factors are different. Sri Lanka risk factor is different to US risk factors. And it may be your fiscal policies of the countries. Taxation rules, fiscal policies can be different from one country to the other. Fifth, demand and supply. Demand and supply. Between the currencies, demand and supply. You would have seen that in April month, Sri Lanka rupee touched 200 rupees per dollar. Sri Lanka rupee touched 200 rupees per dollar. Why? At that time there was a huge demand for dollars and the export proceeds were not coming. So there was a huge demand for dollars. So that impacted the exchange rate. So the exchange rate can be influenced or the varying because various reasons. Interest rate difference, inflation difference, risk factors, fiscal policies, demand and supply. So these are the possible reasons why the today's exchange rate and future exchange rate differ. These two theories, the interest rate difference is explained by interest rate parity theory. Inflation differences is discussed by purchasing power parity theory. So please note, these two theories are telling why your today exchange rate is different from tomorrow's exchange rate, or tomorrow exchange rate why it's different to today's exchange rate. So interest rate parity theory says it is because the difference between interest rates of two countries. Sri Lanka and US interest rates are two different rates. Because of that, today's exchange rate and future exchange rate differ. Purchasing power parity says today's exchange rate and tomorrow's exchange rate different because inflation of two countries are different. So these are two theories which tells why today's rate is different to tomorrow's exchange rate. Interest rate parity says interest rate is the reason, two countries interest rates. Purchasing power says because of inflation. Only thing you need to be remembering, when you look at interest rate parity, it assumes that the today exchange rate and tomorrow exchange rate is different because only reason because of the interest rate differences. No other reason. No other reason. So the assumption of the interest rate parity is today exchange rate and tomorrow exchange rate different. Why? Interest rates are different between the countries. No other reason is there in the market which affects the today exchange rate to be different from tomorrow exchange rate. Purchasing power parity assumes it is only inflation is the reason why today rate and tomorrow rate is different. No other reason. So please understand that this assumes that interest rate is a key reason, not key, only reason. Purchasing power parity says it's only inflation is a reason. So these are two theories which helps the today exchange rate and tomorrow exchange rate to be calculated. So there are formulas in the tute or study pack where you can look at how the calculation is working to forecast your future exchange rate from the today's exchange rate. As a logical thing, say today rate is $1 equals to 183, today's rate is $1.183. 3 months time, $1 equals to how much? Formula is there in the study pack, you can look at it and calculate it. I am only giving you a logical way of understanding here. Today $1.183, 3 months time $1 how much? Interest rates, I am going to take the interest rate parity theory. Interest rate in Sri Lanka, interest rate in USA. In Sri Lanka, say interest rate is say 8%. US dollars say 4%. So interest rate in Sri Lanka is 8%, interest rate in USA 4%. You will see the formula in the study pack how to calculate this number. I am not interested about calculating number, that you can see that. What you need to understand, Sri Lanka interest rate 8%, US interest rate 4%. Today's exchange rate is $1.183. According to interest rate parity, today exchange rate and future exchange rate, there is a difference. Why the difference? Only difference is what? Interest rate difference in the country. No other reason. That is the assumption of the theory. Assumption of the theory is today exchange rate and tomorrow exchange rate is different. Why? Two countries' interest rates are different. No other reason is impacting the future exchange rate. That is the interest rate parity. So according to that, when you have this kind of interest rates of two countries, what will happen? Please note, Sri Lanka has more interest rate than US. If Sri Lanka is having more interest than US, Sri Lanka rupee will in future period, it can be 1 month, 3 months, 6 months, 12 months, if the interest rates of that respective periods are Sri Lanka rupee is more than interest rates of the US, always and always Sri Lanka rupee will, what happens? Rupee will depreciate in future. According to interest rate parity theory, if this is the only reason, Sri Lanka rupee will depreciate in the future. In other words, if you say 183, I am not calculating number, this will be what? More than 183. Sri Lanka rupee will depreciate, US will appreciate. This is the logic. Same thing you apply to purchasing power parity. What it assumes? Today exchange rate and future exchange rate different only because of inflation, not the interest rate, inflation of two countries are different. Again you apply, say this is inflation 8%, inflation 4%, purchasing power parity if we apply, same thing. Sri Lanka rupee will depreciate than US. This is basically a logical understanding you should have more than the formula memorizing. Formula anyway you will understand, you multiply, divide, that's fine. But please note, this is a knowledge. Sri Lanka rupee, if it is depreciating, Sri Lanka rupee has more interest rate than US, Sri Lanka rupee will depreciate. Purely on interest rate parity. Again, purchasing power parity says, if Sri Lanka has more inflation than the other currency, Sri Lanka will depreciate. This is a theory. What you need to understand practical point of view, today exchange rate and future exchange rate will vary. Today exchange rate and future exchange rate will vary, not only because of interest rate, not only because of inflation, many reasons we mentioned. So simultaneously, interest rate differences available, inflation available, demand and supply impacting, many reasons affecting together. So your future exchange rate will be different to today's exchange rate, not for one reason, many reasons. But if you are exam point of view, examiner will say if the interest rate parity is applicable, what is the future exchange rate? So if if you are saying that parity theory, interest rate parity is working, then this is the interest rate or this is the exchange rate in the future. You can calculate. That formula will tell you. So if you are going to have a mix of that, your exchange rate can be different to what you are talking. So as according to this, always Sri Lanka rupee has to depreciate. Why? US dollar interest rate will be cheaper than always Sri Lanka rupee. So in that case, Sri Lanka rupee will always depreciate against dollars. That has been the case always most of the time. But if you are taking other variable affecting you, this can different to what we are talking. Okay. So please note, this is something logical knowledge you should carry more than a formula memorizing. Thank you.